Hello and welcome. My name is Andrew Carrier. I'm joined today by Dolfin's Chief Investment Officer, Vassilis Papaioannou. Vassilis, welcome.
Good morning, Andrew.
It's the first working day of April on this beautiful spring morning here in London. And your team is just about to publish not just its monthly investment update, but also its quarterly investment outlook. And I wondered if we could just start by you giving us a preview of some of the key views from those two documents.
Going into the second quarter, we maintain our neutral positioning across asset classes. I think the main theme will be lack of consensus, persistent volatility, and higher inflation in the US. So we remain neutral on fixed income. We expect US flattening and Europe steepening on the curve side. US remains attractive despite a hawkish Fed, and Europe enjoys ECB's reluctance to tapering. Turning to credit, we focus on short duration and high quality bonds, investment grade and high yield. Equities, we maintain our neutral stance as we expect markets to test levels under a mild recessionary environment, despite good fundamentals and good macro numbers. Commodities, we favor gold as a macro hedge and agricultural commodities being the last segment from the commodities group to outperform. And last, in FX, we remain cautious and take a negative view on the US dollar ahead of what's happening in the US with Trump's policies.
So I wanted to drill down just a little bit on equities. Since our last video, we've had the Facebook data breach scandal, and that's had an impact not just on the so-called FANG stocks, but also the technology sector in general. Do you think we're beginning to see a backlash against that sector, or is it still a good investment?
The FANGs and the technology sector in general has been fantastically performing over this 9-year bull market. But I think that we should be very careful not to see FANGs or technology as one bucket. There are obviously isolated events, the Facebook story, or even Trump's obsession with Amazon. Investors love themes with fancy acronyms, but going forward, I think we need to be cautious in the short term. Because of this good performance, there will be some profit taking coming in. But on the other side, long term, we should be looking to buy, but selectively, not via passive ETFs, just on themes that have interesting stories, but on names that have actual added value in the digital economy.
Thinking about Europe here for a moment, we've passed the 1-year milestone towards Brexit. So in other words, Brexit is starting to feel very real to us here in the UK. What advice do you give investors when they're looking to position themselves in the face of Brexit?
With regards to Brexit and UK assets, we have been cautiously optimistic, mainly due to stabilizing or improving macro and political factors. On the macro side, we've seen inflation coming down from the peak and stabilizing. PMI numbers on a composite or services level have been quite good. The weak spot has been still retail sales, but we are waiting to see improvement on that front. Politically speaking, we have the implementation period being agreed, which is quite a positive, despite confrontations in the public domain or within the UK administration. So all in all, I think that we'll see the sterling going higher, and another area of interest should be high dividend stocks.
When we recorded our last video, you expressed some concern about the US administration's tariffs that they were imposing on steel and aluminium imports. And quite rightly, because since then we've seen retaliatory action from various other countries around the world, most recently China putting 25% on US food imports. How do you think this is all going to play out?
US tariffs should not be taken at face value. I think it's more of a political game as a negotiating tactic, although posing threats to global trade and global growth. In the case of steel and aluminium tariffs, we saw immediately exemptions. On the US side, I think it's more a game with regards to NAFTA negotiations, with regards to US midterm election. When it comes to China, again, obviously we had the 50 billion tariff against Chinese imports, but it's more about a tug of war between US and China when it comes to digital economy, when it comes to artificial intelligence, digital payments, and who has the upper hand in that shift from the old economy to the new economy. So going forward, I think markets will remain unsettled and there will be persistent volatility.
So we've talked about a backlash against technology, we've talked about Brexit, we've talked about trade wars. If there's a theme emerging here, it's surely volatility. Volatility is back foremost in the minds of investors as a concern. How do you advise them in terms of how they should be positioning their portfolio in the face of that kind of volatility?
Investors should rebalance their portfolios, keeping in mind high income and low correlation to dollar and potentially equity beta. They should have bonds and stocks that offer high income. They should have single stocks with high quality characteristics and predetermined stops. EM exposure in countries, regions with low dependency to US protectionist policies. Obviously gold exposure, and last but not least, pair trades or market neutral strategies that have these low beta properties.
Vassilis, thank you very much. Always a pleasure to chat to you.
Thank you, Andrew.
Please visit our website to download both our investment update for the month and also our quarterly investment outlook. Thank you for joining us, and we look forward to seeing you in our next video.